Well, folks, bad news. We might officially be in a recession. We need to talk about why in this video. We need to talk about when markets bottom in this video, because there's a lot of information out there and you kind of got to pick which side to follow on this one. And we're going to talk about how to prepare yourself in all of this. First things first, you probably already heard about the job numbers this morning. I don't want to reiterate the nonsense. What matters most is that this jobs report was 2.6 standard deviations off expectations, which has now triggered the Sahm rule. The Sahm rule being triggered is a recessionary indicator. The St. Louis Federal Reserve, they literally call it the real-time Sahm rule recession indicator. Once it crosses over 0.5, boom, you might already be in a recession. In fact, when you go back here and you look, 1960s, boom, you're in a recession when it crossed 0.5. Over here, boom, 70, you're in a recession when it crossed 0.5. Over here, didn't cross 0.5, no recession. Over here, crossed 0.5, recession. Over here, hit 0.5, didn't exceed 0.5, no recession. Over here, you pass 0.5 recession, pass 0.5 recession. What do you have over here? 0.33, no recession, no recession. Pass 0.5 recession. You get where I'm going with this, right? Every time it goes over 0.5 recession, look at where it is right now. Now, it's not a hard and fast, does not mean with certainty that we are in a recession, but it is quite likely that we have just entered a recession. Some people are going to say, oh, but Kevin, it was the hurricane. It's the hurricane. That's why the job numbers came in low. Okay, then. What's now, though, important to know is that if we are in a recession, when does the market bottom? That's the big question. According to Bloomberg, if you average all of these prior recession indicators, the market bottoms when the Sahm rule triggers. Oh my gosh, that means right now, buy the dip. Hold on, not so fast. I like to look at 2000 and 2008. I take out COVID. And I wanted to see what happened when the Sahm rule was triggered at these levels, because in my opinion, they much more associate with not a run-of-the-mill recession, but rather an insane bubble of some form. The dot-com bubble, the housing bubble, and now the AI bubble. Okay, I'm going to say it. Do I think there's an AI bubble? Yes, I've been complaining about this for a very long time now. And what I found when the Sahm rule was triggered here was very different from what Bloomberg said. And that's my goal on this channel, is to always provide you perspective that at least challenges some of the mainstream perspectives out there, so you get different perspectives. So you can ask yourself, do I agree with Kevin or do I agree with Bloomberg? I'm going to give you both sides and then you can decide. You don't have to pick my side. Now, we did very well in the last, frankly, today did very well. Yesterday I was dumb. I had some AMD calls. I got burned on that. We already talked about getting burned yesterday, but I made more than that burnage back today because my shorts made some really nice dollar hollers. I threw in an IBKR order. The IBKR order doubled my account. On IBKR, I rarely trade on there. My Robinhood account I doubled this week because I threw puts in there as well. I rarely trade in there as well. And then my P&L for today is glorious. 230. So, you could see this is $450,000 in tendies just in the last 24 hours because I have been bearish since July 11th. I didn't play it perfectly over the last 3 weeks, but if you want all my buy-sell alerts just to get my perspective and my discussions in the course member live streams, remember we did extend the coupon code to the end of the day today. We wanted to get through the jobs catalyst. Some people were asking about getting through the jobs catalyst. Here it is. So meetkevin.com to join. You pay once, you're in forever. Price guaranteed to be the lowest you can ever get. Otherwise, your money back. Take a look at this, folks. June 2001, the Sahm rule triggers. Write that down. June 2001, 0.53. That's where we sit today. Now write this down. April 2008 to May 2008, Sahm rule triggers. Write that down. Why does that matter? Because it took a little bit longer for the market to actually bottom out in those cycles. It took 15 to 20 months to bottom out after the Sahm rule triggered in 2001, another asset bubble. It took 9 to 10 months to bottom out after the 2008 trigger another asset bubble. In other words, we could be at the beginning of this sell-off. Now, does that mean the market's going to go straight down? Absolutely not. The market will, in my opinion, absolutely not go straight down. In fact, it will just slowly bleed. Every day you're going to get those people who post, "Oh, look, Kevin, today the stock is up. See, you were wrong." I literally had a financial guy, a money manager. When I said, why would you go long small caps right now? That is the worst thing to own in a recession. It literally had a financial advisor, and I won't put him, I don't want to put him up on blast. And I'll tell you why. 2 reasons. I won't put him up on blast. But on X, at @RealMeKevin, he replies to me and goes, "Oh, okay, Kevin, I think you're going to be wrong." The very next day, IWM's like up 1.5% small caps. He's like, see, Kevin was wrong. Tom Lee is right again. Tom Lee's always right. Now, look, I'm not here to declare victory right now, but if you look right now, so to me, it looks like investing in IWM was a bad idea, is what it looks like right now. And I think, frankly, it's just getting started. Because if we are triggering a recession warning, the stupidest thing to own are small caps, because they're the ones that are going to go bankrupt. You would be better off buying the dip on Nvidia, which I think is a bubble risk. You would be better off buying the dip on Amazon as the next Walmart than you would be buying the dip on the Russell, where you're going to have a bunch of BKs weighing this sucker down. No way, Jose. Anyway, as a result of this sort of tiff, the reason I don't want to put that person on blast for, critiquing me that very next day is because he ended up deleting his post, so I couldn't find it again. And I didn't even say anything. I'm not like prancing around trying to declare victory today. I didn't even say anything. But all of a sudden, I'm like, I wonder what Tom Lee's saying today. I wasn't even going to say anything. Was not even going to say anything, and this is what I get. I got a thank you card in the mail from Tom Lee. There it is. On screen right there. Anyway, listen, the greed and fear index is something that we need to pay very close attention to. Folks, yesterday we were at 40, 39. Today we're at 26. This is probably going to keep going. Why? Because market momentum probably has to go below the 125-day moving average, and stock price strength needs to move out of extreme greed. You need all of this to be fear, fear, fear. We're not there yet. The VIX has skyrocketed. Safe haven demand skyrocketed. Junk bond yields have skyrocketed. We're about to re-invert on the yield curve. Now understand what that usually signals. When the difference between the 2-year and the 10-year goes positive again after having been inverted, it usually means you have begun a recession. We are currently 9.9 basis points inverted. We are a 9 basis point spread away from once again triggering a recession with now a second indicator. Not there yet. So far, it's just the Sahm rule. This is not good. Now, I also want you to remember there's a very, very key signal that we saw this morning. This morning, Jim Cramer was asked, are we going into a recession? And Jim Cramer said, no, of course not. I'm very nervous. JP Morgan, Citigroup are all increasing their odds of a Federal Reserve rate cut. Nick T, also famously considered Nikki Leaks, believes that a lot of institutions are now ramping up their interest rate cut projections. And I'd like to tell you something. I think they're all wrong. These numbers are all going to end up being too low over time. Now, do I think there's a likelihood of us getting a 50 BP in September? Folks, if the market continues to correct the way it is correcting now, we are going to get a lot more than a 50 basis point cut. The Federal Reserve will declare victory on inflation, and in order to preserve the jobs market, the Federal Reserve will cut rates back first to 2% and then to 0%. They will do so rapidly. They won't do so based on just today's jobs report. In fact, they're going to try to exercise restraint, and they will wait. They will wait until, unfortunately, it's too late, and they'll have no choice but to cut rates back to 0. That's when you're going to get a lot of folks who argue, oh my gosh, this is going to set off a second wave of inflation. No, it's not, because everybody's going to be jobless You're going to have manufacturing supply chains that are so freaking loose that you can't have inflation because nobody can raise prices, even in an environment of low interest rates, because nobody will be able to finance anything because A, they'll either have lost their jobs or their hours will have gotten cut or their salary will have gotten sliced. I talked about this today in my course member live stream. Listen, I'm not always right in my trades. I always make that clear. I'm not always right in my trades. I do not guarantee that you are going to make money. But what I do every single day is I show up. I try my best and I give you perspective. And I'm going to give you a little spoiler alert of what I talked about to course members today. I said, listen, if we don't go into a recession, fantastic. But if you ask yourself right now, is now the time to buy the Cybertruck? Is now the time to YOLO all your money on new clothing, an expensive vacation, a home edition? Is now the time to put your family's future at risk, or is now the time to be cautious? My belief is the time is to be cautious. My belief is you should cut your expenses. My belief is you should pretend, or you should go through an exercise with your family right now. What are we going to do if one of us loses our jobs? What are we going to do if my salary gets cut in half? What are we going to do if we both lose our jobs? What skill set do we have to get another job? What are we going to do? Those are the exercises to start thinking about now. Worst case scenario, you don't lose your job. No recession, everything goes back to normal. Fine. Big deal. You cut expenses. You were safe. But what happens if you don't pre-plan for that and then you get rugged? Your boss calls you up and says, hey, you were making 150K, 100K a year, 80K a year. Now you're making 100 or 50. Don't like it? Bye. I got 20 other people willing to do the same work for that pay. This is a time to cut expenses. It is very, very, very scary. And look, there are going to be green days. This market will not fall off a cliff. I think, frankly, you could go into a 10-month bear market. Yikes. So, now people are speculating on, okay, well, what's going to do well in a bear market? Well, potentially nothing. But if I had to guess, probably gold. If we do go into a recession, I hate saying it, but probably gold, McDonald's. I actually think Amazon will be a form of McDonald's. Like, I'd way rather be in Amazon than NVIDIA. I'll take the AI play on Amazon, and I'll take that people are going to try to get the cheapest product possible on Amazon. They will be the dollar store you want to invest in. Because if you invest in the dollar stores, they could go bankrupt. I'm telling you, you come here for the perspective that you didn't even consider. Jay Powell will probably commit to rate cuts at J-hole. He kind of already did, but he'll probably recommit to cuts, maybe even 50 at J-hole. So maybe markets will bounce there. They will not go down in a straight line. So I think you take your tendies when you can and you reopen positions as you'd like. But what I'm looking at is when I look at a company like Amazon, I think they are going to be a company that will be the dollar store of the future. You go, take them right now at a 166. That's actually a fib retracement level. 166 divided by 557. They're trading for 29.8 times earnings. Now you look at their forward growth, which could get skewed. Obviously, these growth estimates could get skewed, especially if you're in a recession. But you're looking at growth of 19 plus 18 plus 26, 78 plus 13, 39. You're looking at growth of 77.9% over the next 4 years. I actually think it'll be greater than that. You're sitting at roughly a 1.5 peg. For a company that gives you AI exposure, but is not purely part of the AI bubble, it didn't run up like all the other AI plays, and could be the dollar store of the future, and Walmart is sitting at crazy excessive valuations, I don't know. I prefer Amazon, ironically, on the dip, and McDonald's on the dip. Remember my 2x2 foundation model. It's inspired by Rust. The 2x2 says you want to buy companies that do not have a bankruptcy risk. To me, that kills a lot of dollar stores already. A lot of them don't have the strongest balance sheets. You want an Amazon and McDonald's. They're not going to go bankrupt in the cycle. I want valuation. McDonald's and Amazon mostly have that right now. Amazon certainly does. McDonald's is a little bit richer, but I'm okay with it. Sentiment and momentum. The sentiment on both of these is trash. I like buying when sentiment is trash on those companies. And pricing power. Both of these companies, both of these brands have absolute pricing power. There is not a doubt in my mind about both those companies. Now, would I hedge by being, maybe short the Qs or short, some AIs? Of course. And again, we will bounce. We had a little bit of a bounce this morning. We'll probably bounce again next week. But the next 3 months going into the election, I don't want to be uber bull. I don't want to be an uber bull in this environment. Get me through the election and I'll consider it. I'll consider it at that point, but not earlier. Not any earlier than that. So I really want folks to think about this, not from the perspective of fear-mongering. We could bounce, we could rally again. That's okay. I'm all right, sitting on the sidelines and enjoying. But what I want to know, sort of just watching. Cash, raise cash, short to hedge your longs. That's the point, really, of hedging, right? But what I want to know is, when's the market really going to bottom? I think the market bottoms either when we confirm a soft landing, which would be a very soft bottom. It would be a very blurry bottom, a very volatile bottom. Or when the Federal Reserve freaks out and full-on bailouts. There were 2 cases that has happened previously in the past. One is when they joined the course member live streams themselves and said, we're going to the moon. Okay, that never happened. That was really just a sly pitch, probably relatively weak for me to remind you about the expiring coupon code today. One was actually February 10th of 2009, when the Federal Reserve released the following statement. The Federal Reserve Board on Tuesday announced it is prepared to undertake a substantial expansion of the term asset-backed securities loan facility. The expansion could increase the size of the TALF to as much as $1 trillion and could broaden eligible collateral to encompass other types of newly issued AAA-rated asset-backed securities, such as commercial mortgage-backed securities, private label real estate mortgage-backed securities, or other asset-backed securities. In other words, the massive QE1 that was actually authorized in November of 2008 under the Section 13.3 Emergency Lending Program. This was announced in November of 2008. This wasn't enough. It took the Fed really panicking and going for a level of bailout they've never done before. And that's what you got in February of 2009. Look at when the stock market bottomed, February of 2009. How about March, when the Federal Reserve, or February to March of 2009 or 2003, when you had your second double dip, and the Federal Reserve basically gave the monetary policy and economic outlook commitment to Congress that they will stop at nothing to protect this economy and the market bottom. That's the kind of Fed you need. They weren't yapping about a dual mandate of inflation. They've talked about one mandate. We'll do whatever, man. We need to bail this crap out. It's like when the Fed came out in March of 2020 and said, we will buy everything. Infinite bailout. We'll even buy stocks. That, my friends, is when the market bottoms. That is when you go shopping. I'm just going to keep doing my best. I'll be here every day. I know people make fun of me. They call me a flip-flop or whatever. In volatile times, it is challenging to be perfect. In fact, in any time, it's challenging to be perfect. And I don't confess to being perfect at all. I don't even confess to being good. I confess to being some dude on the internet who does his best and will share his perspective with you. And if you want that perspective in the form of course member live streams, meetkevin.com. If you want it in the form of these free videos, here you go. If you want it in the form of trade alerts, no guarantees we can make money. Obviously, today we had a phenomenal day. Up over 450K. It was a phenomenal day and made up for a stupid decision on AMD, Then you can get those. So anyway, we'll see you there. Thank you so very much for being here. By the way, if you are a course member and you want to get free access to the market live chat so you could chat for free and you don't have to be a green chatter, you can get a wrench when you join. Just leave a comment on today's course member live stream and say, please wrench me, bro. I will always wrench you. We'll see you in the next one. Thanks, folks. Bye. Good luck. These
things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.